Usually when we look at national commercial real estate headlines right now, um, it feels a bit like reading a disaster novel.
Oh, yeah,
I
totally.
mean, empty skyscrapers, plummeting valuations, massive defaults. It's a landscape that is honestly just pretty bleak.
Right. The dominant narrative across the country is very much focused on distress, navigating debt maturities, and, just trying to figure out where the actual bottom is.
But then you zoom in on Spokane, you pull up the Q2 2026 data, and the office vacancy rate is sitting at a rock-solid 7.2%, which
It's completely defying the national real estate chaos.
exactly. But when you take a magnifying glass to that stability, you realize the market's momentum is, well, it's currently hinging on a handful of massive, highly specialized medical deals.
Yeah, it's a textbook market contradiction. You have this beautiful, stable headline number, but it's masking some very specific, highly concentrated, localized currents beneath the surface.
Well, welcome to our custom-tailored deep dive into the Spokane office market. We are taking the Q2 2026 market report, with all these incredible figures coming directly from CoStar data compiled in July of 2026. And we're unpacking exactly what is going on behind those numbers.
Our mission today is to move beyond the top-level stats. We are going to extract the most crucial insights, look at the mechanics of, why this market is behaving so differently, and give you a clear, actionable picture of the landscape.
And we are going to do all of that in under 20 minutes.
Yeah.
But before we jump into the deep end, I want to mention that if you are looking for a custom market breakdown, or if you just have specific questions about how this data impacts your own portfolio, you should definitely reach out to Eric Peterson at ACTIV8, Activate Real Estate, and you can call him directly at 509-903-9077.
Yeah, I highly recommend giving him a call. So let's set the baseline for the quarter.
Starting with demand and supply. As we just mentioned, vacancy is incredibly tight at 7.2%. And the reason for that becomes pretty obvious when you look at the construction pipeline. I mean, there is almost nothing being built.
Right.
The data shows just 57,000 square feet currently under construction.
Which naturally impacts pricing. Because supply is so constrained, asking rents are holding really steady, currently sitting at $21.39 per square foot gross.
Let's pause on that term for a second, actually, just to make sure we're all on the same page. When the data says $21.39 gross, how does that compare to the triple net leases we often see in other asset classes?
That's a really important distinction. So in a triple net lease, or NN, the tenant pays a base rent, plus their proportionate share of the building's property taxes, insurance, and maintenance.
So the landlord essentially passes those operational risks down.
Exactly. But a gross lease, which is very common in traditional office space, means that the $21.39 covers almost everything. The landlord pays the taxes, the insurance, and the structural maintenance out of that gross figure.
Got it. So the landlord is absorbing the operational cost fluctuations. Moving to the capital market side, the market cap rate is hovering at 10.2%, with trailing 12-month sales hitting $85.9 million.
And if you take away just one core concept from this entire discussion, let it be this. Spokane's office market is surviving the national storm not through some unprecedented surge in tenant demand, but quite simply by never overbuilding in the first place.
Yeah, and that dynamic is wildly apparent when you look at the broader Pacific Northwest. Because for anyone investing in this region, the contrast is just staggering. Look at Seattle right now.
Oh, Seattle is rough.
They are sitting at a massive 25.2% office vacancy rate. That is the highest of any major U.S. market in 2026.
And the truly wild part about that Seattle figure is that 25.2% is actually an improvement.
Wait, really?
Yeah, that is after a 180 basis point recovery. Meanwhile, if you zoom out to the entire U.S., the national average over the past 5 years has hovered around 13.3%.
And then there's Spokane, just chilling at 7.2%. It's a fraction of Seattle's pain. How is the gap that wide?
Well, you have to look at the historical supply pipeline. Over the last 5 years, Spokane's total office inventory has shifted by only 0.3%. Think about that.
Wow.
Over half a decade, they basically haven't added any net new buildings. Right now, there's exactly one building, that 57,000 square foot project we mentioned, under construction out in the valley.
It's like a game of musical chairs, where the person running the game never added any extra chairs to the room in the first place.
Right.
So when the music stops, everyone just stays seated in the chair they already have.
That analogy perfectly captures the mechanics of the market here, and it explains why landlords in Spokane are successfully preserving their pricing power. We are actually seeing rents up 1.2% year over year.
Wait, I want to clarify something there. Are rents going up because companies are actively fighting over premium spaces and, like, bidding up the price?
No, not at all. There are no bidding wars here. Rents are inching up because tenants simply have nowhere new to go. Sublet space remains a very small fraction of the total availability. Most of the vacant space on the market is direct space. If a local company wants to move into a shiny, brand new Class A building, the kind of high-end, amenity-rich buildings that companies use to lure remote workers back to the office.
It just hasn't been built.
Exactly. It doesn't exist.
So they just stay put. They renew their current lease, and the landlords maintain their leverage without having to offer the massive rent concessions or tenant improvement allowances we are seeing in larger coastal cities.
Yeah, the lack of alternative options is essentially acting as a protective moat for existing landlords.
Okay, so constrained supply is the hero of the vacancy rate. But when I look at the demand side of this CoStar data, I see a glaring contradiction.
What do you mean?
Well, if supply is virtually zero and vacancy is sitting at a healthy 7.2%, you would assume companies are desperately leasing up whatever space is left. Yet the 12-month net absorption was actually negative. The market gave back 15,300 square feet.
Yeah, that is the pivotal nuance of this quarter's data. Slightly more space was vacated by tenants than was leased up by new ones.
So how does a market maintain low vacancy while simultaneously shrinking its leased footprint?
To answer that, we have to look at the underlying employment data. Overall employment in the Spokane metro area grew by an impressive 6.1% over the last 5 years. The regional economy is undeniably growing.
Okay.
But office-using employment, that specific subset of jobs only grew by 2.2%, reaching about 43,000 jobs.
Wow. Nationally, office job growth was 5.3% over that same 5-year time frame. So Spokane is heavily lagging the national average when it comes to creating traditional office jobs, even while its broader economy is booming.
Correct.
I have to push on that. If the regional GDP is expanding and overall employment is up over 6%, but the traditional office workforce is barely moving, what are these companies doing? Are they just cramming more employees into the same square footage using hybrid schedules? Or is the nature of the economic growth fundamentally different here?
The data points strongly to the latter. The economic growth in Spokane is heavily concentrated outside of the traditional finance, tech, and insurance sectors.
Which are the typical office users.
Exactly. Those are the industries that typically gobble up massive, multi-floor blocks of downtown office space. But in Spokane, the engine of growth is healthcare, it's education, it's manufacturing and logistics.
Which means the traditional office footprint just isn't expanding at the same rate as the regional economy. It honestly makes that 7.2% vacancy rate even more impressive.
Yeah, it really does.
It's holding steady despite a relative lack of job growth in the very sectors that actually use those buildings.
And it also completely changes the profile of who is actually buying commercial real estate in this market, which is a perfect pivot to the investment side of the equation. Right now, we are looking at a transaction market that is fundamentally thin and lumpy.
Thin and lumpy. I've heard that phrase tossed around. How would you visualize that for someone looking at these transaction charts?
Think of the Spokane transaction market like a very shallow pond. That's the thin part. The overall baseline volume of sales is relatively low. Because it's so shallow, if you drop one large boulder into that pond, it makes a massive splash that disrupts all the water. That's the lumpy part.
Oh, I see.
A single massive transaction can completely distort the averages for a given quarter.
That makes total sense when you look at the numbers. The trailing 12-month sales volume is $85.9 million. That feels pretty soft compared to the 5-year average of $101 million.
Yeah, the baseline transaction velocity over the last year has indeed been sluggish, which reflects the broader, higher interest rate environment. The cost of debt is keeping a lot of everyday investors on the sidelines.
But then you isolate just Q2 of 2026, and the market saw an incredible $43 million in sales. I mean, half of the entire trailing year's volume happened in just 3 months.
Right.
Especially when you compare to Q1, which only saw $13.6 million in total sales.
This is why you can't just glance at a quarterly chart without understanding the context. Is the market weak, or is it gaining momentum?
Well, because of the lumpy nature of the data, both statements are simultaneously true.
Right, that makes sense.
The everyday street-level transaction velocity is weak, but one or two institutional-sized deals made Q2 look like an absolute blockbuster.
So we need to look at the boulder that made the splash. Let's dig into the actual deals driving these numbers.
The Q2 Boulder was a major institutional medical deal. In May of 2026, we saw the closing of the Montecito Medical and Spokane Eye Clinic medical office portfolio.
And that one portfolio was the primary driver of the entire $43 million Q2 volume.
It was, and it highlights a critical theme in Spokane right now, the absolute dominance of the medical sector.
Yeah.
When institutional capital decides to deploy in this market, it isn't buying a tower full of tech startups. It is targeting highly specialized, recession-resistant assets like clinical spaces.
I mean, you can't exactly perform an eye surgery over a Zoom call. That space is incredibly sticky. The stickiness is the entire value proposition. Think about the build-out costs for a specialized medical facility. We are talking about heavy-duty HVAC systems to maintain sterile environments, reinforced floors for medical imaging equipment, complex plumbing networks for clinical sinks, sometimes even lead-lined walls.
Right.
A tenant does not invest millions of dollars into that kind of infrastructure just to box it all up and move across town for a slightly cheaper lease rate.
So the tenancy is incredibly stable, and that is exactly what institutional capital is looking for to mitigate risk in a high-interest rate environment.
Precisely.
But it's not just giant funds buying up these spaces. I was looking at the Washington State University deal,
Yeah.
and the mechanics there are fascinating because it's an owner-user play.
It is a fantastic example of a long-term strategic real estate play.
Yeah.
WSU purchased a medical office building in the University District for $8.3 million. That breaks down to about $211 per square foot.
But they didn't just tour a random vacant building and decide to buy it.
Right. No. WSU had actually been a tenant in this specific property for over a decade. They use it to house their innovation center, which serves as a startup incubator with specialized lab spaces.
So they essentially did the math, looked at their long-term footprint in Spokane, and executed an owner-user conversion. They went from bleeding cash on rent checks every month to capturing the equity and owning the asset outright.
And we are seeing this exact psychology play out across the trailing 12-month data. When you look at the notable context deals, private and owner-user activity is really standing out.
Yeah, let's highlight a couple of those smaller deals for context. Down in the Valley Submarket, 325 South University Road sold for $5.6 million back in October 2025. That building was 100% leased, and it traded for a massive $775 per square foot.
Which is huge. A valuation like that in the Valley submarket is entirely driven by the quality of the physical asset and the absolute security of the tenancy in place.
And then, on the much smaller side, you have 90718 North Morton Court, sold for $1.3 million, which is about $392 per square foot in August 2025. And the buyer, Back in Motion Chiropractic, another owner-user taking control.
Right, another medical professional deciding that physical control of their real estate is a better long-term financial strategy than navigating lease renewals in a supply-constrained market.
Looking at all this data, eye clinics, universities, chiropractors, it feels like office space in Spokane is basically just medical and educational space in a trench coat right now.
That is an incredibly accurate way to frame it. Traditional corporate office demand is essentially flat. The slack in the market is being entirely taken up by meds and eds.
Meds and heads.
Yeah. These are entities that require physical presence, require specialized build-outs, and often have the capital on hand to just buy the building outright when the math makes sense for their operations.
So if the market is being driven by these specialized medical and educational users, and new supply is practically zero, how does this translate to broader valuations? Like if you were an investor looking at Spokane versus other cities in the Pacific Northwest, what does the math actually look like?
Well, to truly appreciate Spokane's resilience, we need to compare it to a market that experienced the speculative highs of the last cycle. Let's look at Portland.
Oh boy. Portland has had a notoriously brutal run in the commercial sector lately.
Yeah, Portland saw a historic pricing collapse. From 2020 to 2025, the average office sale price plummeted by 73%.
Wow.
It bottomed out at around $91 per square foot before slightly recovering to $119 per square foot recently.
Wait, 73%? That isn't just a market correction. That is a complete wipeout of equity. How does a major metropolitan market lose nearly 3/4 of its value?
It happens when a market becomes over-leveraged at peak pricing, heavily reliant on a single booming sector like tech, and then gets slammed by a perfect storm.
Which would be what, exactly?
A combination of remote work, massive new supply deliveries that were started during the boom, and suddenly tightening debt markets. Landlords who bought at $350 a square foot suddenly had to refinance their debt when the building was half empty and worth a fraction of the price.
Ouch. But then you contrast that bloodbath with Spokane. Spokane's market prices remained remarkably steady at around $125 per square foot, and the trailing 12-month average for actual closed deals is sitting even higher at $154 per square foot.
Yeah, Spokane is holding its value significantly better than its much larger neighbor to the southwest. And a huge reason for that resilience lies in the mechanics of cap rates and leverage.
Let's dig into that cap rate math because I think it's the secret engine of this market. The report shows the market cap rate in Spokane is 10.2%, though actual deals over the last year have ranged anywhere from 6.4% on the low end all the way to 11.4% on the high end.
That 10.2% average is really vital to understand. Historically, Spokane has always maintained higher cap rates than the large coastal markets like Seattle, Portland, or San Francisco.
Okay.
In the old low-interest rate environment, coastal investors would accept a 4% or 5% cap rate just to park their money in a core urban asset. Spokane was always viewed as a secondary or tertiary market, so investors demanded a higher yield, say 7%, 8%, or 9%, to compensate for the perceived lack of liquidity.
Okay, but now the cost of borrowing has gone up everywhere. The 10-year treasury shifted, and suddenly cheap debt is just gone.
And that is exactly where the coastal markets broke down. When lending conditions are tight and interest rates are higher, those 4% cap rates on the coast cause a mathematical crisis called negative leverage.
Walk me through that math. Why is negative leverage so toxic?
Imagine you are buying a building that generates a 4% yield, but because interest rates have risen, the bank is charging you 7% interest on the loan you used to buy it.
Oh, I see.
You are literally bleeding cash every single month just to hold the asset. The math is upside down, it doesn't pencil out.
But in Spokane,
Because the baseline cap rates were already higher, buyers here have a built-in cushion. If you're buying a medical clinic in Spokane at a 9% or 10% cap rate and your debt costs 7%, you still have positive leverage.
wow.
You can secure the debt and actually make the acquisition cash flow positively from day one.
It's fascinating that Spokane's historically boring metrics, having higher cap rates, demanding higher yields, and having absolutely zero speculative development, are actually its ultimate superpower during a national downturn.
It really is.
It's like the tortoise and the hare, but the tortoise is a mid-sized metro in eastern Washington, just steadily paying out positive yields, while the hares on the coast are dealing with negative leverage.
Yeah, it is a textbook example of how avoiding the extreme speculative highs of a boom cycle naturally protects you from the devastating lows of a bust cycle. The market just chugs along, protected by its own lack of drama.
So what does chugging along look like for the rest of the year? What is the forecast for the back half of 2026?
Well, the forecasting data suggests more of the exact same stability. The vacancy rate is projected to hold completely flat at 7.2% straight through the end of 2026.
So no dramatic spikes in vacancy, but no sudden drops either.
None. Rent growth is expected to track at about 1.1% for the year, which is just a hair shy of the national forecast of 1.3%.
Got it.
If you are an owner or an investor listening to this, do not expect a sharp V-shaped recovery where valuations suddenly soar. But conversely, you shouldn't be bracing for a massive correction. Demand and supply are fundamentally structurally balanced.
Which is a remarkably rare thing to be able to say about any office market in 2026.
It is rare. But, if we pull all these threads together, the lack of traditional office job growth, the heavy reliance on medical and educational buyers, and the aging inventory, it raises a really critical forward-looking question.
Okay, what are you seeing on the horizon?
If Spokane's office market is currently being propped up almost entirely by medical, educational, and owner-user deals, what happens to the older, traditional corporate office spaces over the next 5 to 10 years?
Oh, right, like the 1980s and 90s mid-rise buildings.
Exactly. If remote and hybrid work has permanently capped traditional office job growth in this region, who will be the next generation of tenants to fill those very specific cubicle-heavy suites? You cannot easily turn every aging corporate mid-rise into a dental clinic.
Right, because the infrastructure we talked about earlier, the plumbing, the HVAC, the floor loads. Trying to retrofit a standard 1980s office suite for heavy medical use would be an absolute nightmare of capital expenditure.
The conversion costs would be astronomical. So the market is highly stable today because total supply is constrained, but the fundamental nature of demand is shifting right beneath our feet.
Yeah.
The space that exists doesn't necessarily match the profile of the tenant that is growing.
That is Definitely something for you to mull over as you evaluate the long-term health and utility of your own assets. If this deep dive sparked ideas for your portfolio, or if you want to dig into these numbers and see how they apply to your specific situation, you should definitely contact Eric Peterson at ACTV8 Real Estate.
Absolutely.
You can call him directly at 509-903-9077. Again, that's 509-903-9077.
He is the one with his finger on the pulse of exactly how these localized, granular trends are playing out on the street level.
We started this deep dive by talking about how national real estate feels like reading a disaster novel. But it turns out when you look specifically at Spokane, the story's entirely different. It's not a booming gold rush, but when you're the only city that remembered to stop adding chairs to the musical chairs game, just having a secure seat with positive cash flow is a massive win. Thank you for joining us, and we'll catch you on the next deep dive.